Hey everyone, how's it going? My name is Ihan Isaacs. I'm the head of global growth for the Founder Institute. Thank you so much for taking time out of your day today for joining us. This is our third event for the 2024. We have a powerhouse of event. We had over 900 people sign up. Super glad that everyone can be here. Everyone who's come here to attend today's event knows that we're here to hear Eric Bahn speak from Hustle Fund. Super excited for him and to listen to what he has to offer and like some of his insights around fundraising and all his expertise around this space. So those of you who don't know him, go. I'm telling you now, drop everything. Go follow him on Twitter. We'll share his handle shortly, and also follow him on LinkedIn and other places. Just some housekeeping before we bring up Eric. This platform is known as AirMeet. We use it for all our global events. As you can see on the right-hand side of your screen, if you're on a laptop or desktop, there is a chat function. Please use the chat to communicate with everyone. Underneath the chat button, the chat icon, there's a Q&A button. Use that to feed us questions. Towards the end, we will do a Q&A portion. And at the bottom of your screen, you will see a bunch of emojis. So if you like some of the content that Eric is going to be talking about later on today, just exactly show us some of that reaction. All right, I think that's about it. Oh, sorry. In terms of an agenda, I will bring up Eric. He'll do his presentation or his kind of talk for about 30 minutes. We'll do about 20 minutes of Q&A, and then we'll wrap up with some open networking. You'll all see some virtual tables. Feel free to network with each other. You can create your own tables. That's the opportunity to go and meet with each other and like just talk about your learnings and findings. All right, while we're bringing up Eric, let us know in the chat where you're dialing in from. I'm based in Dubai, UAE. I saw that we have a lot of different locations earlier. I saw Deerfield, Chicago, Houston. Where else are you? Jacksonville, Vancouver. All right, a pretty international audience. I think we're close to 300 people live. Let's bring up Eric. Just give this a sec. Prague, Bonn, Germany. Awesome, Eric. Are you live with us?
Yes, we are here. And thank you so much to you and the Founder Institute team and everyone in the audience for spending a bit of time in your busy day throughout the world to join us today.
I'm going to hop off. I'll come back for questions, but all right, Eric, over to you. Thank you.
Thank you so much. All right, so here's how things are going to go down today. I have about 30 minutes of content that I'm going to be sharing with you, but this is an hour-long session, so there will be plenty of time for open Q&A, as well as a little bit of networking time before the hour is done. And again, I'm so grateful to have a little bit of your time today. And what we're going to be discussing is actually kind of like two topics I wanted to merge into one. So orienting around seed fundraising, what are the key components of a really good pitch deck that I look for to decide investment? And then I think the second part of it is let's talk about 2024. And I can share a little bit of perspective as a VC, what I'm looking forward to, the trends I think are going to impact seed fundraising and so forth. So we'll make this a lot of fun, I hope. And then I'm really looking forward to your Q&A at the end. So be prepared for that. So before we get started, I'll share like a super quick introduction. Venture capitalists have a really terrible habit of making extremely long bios about themselves. So I'm going to just isolate it down to just two fun facts. Okay. So fact number one is that I'm in the midst of a midlife crisis. So I recently bought a cheap sports car. Just 2 days ago, I bought a CRT TV, one of those old TVs from the 90s, so I can hook up my Nintendo system, which me and my kids have been playing ever since. It's a lot of fun. I'm not going to leave my wife, though. She's the woman of my dreams. So that part of it, I'm just going to hang on to. So that's fact number one. Fact number two is that I'm one of the co-founders at Hustle Fund. And I actually lead the fundraising for our fund. And to date, we manage about 130 million under management. So fundraising, talking about this topic is something that I'm really passionate about. And we have a portfolio of over 500 companies at this point, and I love advising them on their fundraisers as well. Hustle Fund focuses on pre-seed stage investments. So we like to invest alongside of angels, or in some cases, even family members and friends. We're trying to design an institution that comes in really early to serve software startups throughout the world. All right, so that's all I want to say on this topic. I don't really have any slides. I have a little bit of show and tell in the middle of this session, but I want to actually speak to you directly in the camera to talk about, let's talk about the 5 slides that every founder needs to have in order to raise their seed fundraising. So assuming that many of you in this audience are looking to raise pre-seed, seed, post-seed, whatever it is, I'm going to guess many of you are early stage. And one of the things that kind of surprised me, at least, when I first became a venture capitalist, because I was a founder just like yourself for like 15 years before I jumped on this side of the table to become a VC. The big surprise for me was that it really comes down to just 5 slides that you got to nail to probably put together enough interest for that fundraise. So the slides are team, problem, solution, market, and traction. And I'm going to go into each one of these and try to share a couple of examples of these dimensions. And I'm hoping that many of you will have questions at the end around some of these parameters that we can get to in even more depth. So let's start with the most important slide of any pitch deck, which is team. So I'm going to go out there and say, like, if you're like pre-seed or seed, 70% of the investor's decision is going to be made on this one slide alone. So for a team, this really comes down to answering the following question, which is this set of co-founders or just founder alone, does this person actually possess the relevant skills and backgrounds needed to solve the given problem and market that they are serving? Okay, so I'll give you an example of a bad team and a good team. A bad team would be like, you meet this guy, Eric, and I'm going to pick up my co-founder, Elizabeth. Let's say you meet Eric and Elizabeth, and we're pitching to you saying, like, I got this great startup idea. We're going to cure COVID with just one tiny little pill. You just take it once and it cures COVID forever for the rest of your life. And as an investor on your side of the table, you might think, oh my gosh, this has to be like a multi-trillion-dollar opportunity to like solve like this global pandemic or whatever, right? And then naturally, the next question you might ask is like, well, tell me more about your background. And then I go in and say, well, I have a degree in sociology and I worked at a product manager at Facebook. And you're thinking like, this is a waste of my time. These people have like no rights to be pitching a company idea like this, even if the idea is great, because they have no relevant experiences to solve the given problem in this market. Now, let's pretend that it was a little bit different, which is like me and Elizabeth are pitching you. And then we say, we're going to cure COVID, one pill, right? And then you ask for our background. So we say, well, Elizabeth and I used to lead an R&D lab at Genentech focused on virology, right? And we have cured many viruses of corona variants in the past over 15 years of shipping together, right? Okay, at that point, you're probably thinking, okay, these people seem to have much more credibility, right? Hopefully we have like PhDs in, microbiology or virology or whatever those kinds of degrees are needed to cure this disease, right? So better team, right, is quite relevant. Now, I actually kind of hinted about a second dimension on team that's really critical, which is, for me, how long has this set of co-founders been working together? I don't believe in marriages of convenience. I think a bad example of this is like, hey, I met Elizabeth at a hackathon last week, and we decided we like each other, and we're going to start this company. The problem with that is that a startup will take at least 7 to 10 years from inception to IPO or massive acquisition, right? Probably even longer than that in this era. And when you are a founder with another set of co-founders, and many of you already understand this is a relationship that's deeper than even like a friendship. It's not quite like a marriage, but it's sort of close. For me, like my co-founders at Hustle Fund are essentially sisters to me, right? Like that's kind of like the level of trust that we have with each other. So, what helps is to see some longevity in the relationship. It also helps to see that this is a team that's worked together in the past. They've shipped things together in the past. And I think that kind of rounds out, I think, a really great team. Okay, so that's team. The next one is problem. It's not enough to just say, hey, we should have, it's not enough to just have a great problem statement. Like, we should have Uber for young families. So some of you might see in my background, I actually have a car seat here because I do have a young family, and maybe you have some kids out there and can understand this example, which is, if I'm going to go to the grocery store, I don't want to like carry a car seat or a booster, when I take my ride share. That's just not going to happen. All right. So that is like a kind of a nice problem to solve, but I don't think that's enough. what a VC wants to understand is actually your obsession with understanding all dimensions of this problem. Is that so? In this case, like that Uber for Families thing, is that a problem that's isolated only to 40-year-old Korean men who live in the San Francisco Bay Area? Or does it span like other geographies, other demographics, other socioeconomic bands, and so forth? How many people did you talk to arrive to this conclusion? So a good response to like the problem statement is like, hey, like this is the problem. By the way, I spoke to like 300 families, of a wide breadth of inclusive experiences and backgrounds. And we discovered that everyone wants this thing, right? Like that kind of a customer discovery path that led you to validate this problem statement, I think is something that demonstrates that this isn't just like a mercenary thing where we think we can just make a lot of money alone, but it just feels like a passionate mission of yours that you want to solve. And we're in the business and venture to hopefully serve missionaries, not mercenaries, those who are going to stick with it because they just are obsessed with this idea of changing the world in the vision that they have. So we talked about team. We talked about problem. Let's talk about the solution now. So the solution is, what is the current product or service that you've created to solve the given problem? And when you're an early investor like myself doing pre-seed, generally most of the products and services I'm seeing are quite terrible. Just because it's so early on, you might have just like Figmas or early prototypes or crappy MVPs. That's totally fine. We're in an era where software development is getting easier, cheaper, faster. And I just assume that things are going to improve from here. But it is kind of nice if I can have a chance to engage with a product or see a demo to see what your vision of what this user experience would look like. Right. So this is one of the more forgiving dimensions for me. And the earlier you go, the more forgiving it is. The later you go, the less forgiving. Now, as you're approaching like your Series A, and definitely beyond that, you probably should be able to demonstrate a fairly robust product or service at that point, right? And be prepared to start talk about the underlying technology, why there's defensible moats there, and so forth. But at seed, I wouldn't worry about that as much. This is more about just like showing a rough cut of what the vision could look like. We talked about team, problem, solution. Let's talk about market. All right, so this is one where I think a lot of founders, frankly, mess up quite a bit and not focusing enough time on this market problem, all right, or this market slide. So largely the answer that you need to have is it's super big, right? If you're going to be going after outside capital, especially venture capital dollars, you need to make the case that this is a venture backable business. Okay, so what is a venture backable business? Well, for me, it's defined really simply. And this might be just a hustle fund thing, which is like at the post-money valuation that I can invest in your company, do I think that I can 100x our money? So if I invest into your company $1 million, do I think that after 7 to 10 years or whenever you get acquired by Google or IPO or whatever, you're going to return $100 million to me? That is the threshold earlier on. Now, these multiples get lower the further you go along. Maybe at Series A, it's like 25x. Maybe at like Series F, right before your IPO, it's like 1.2x, But the earlier you go, the multiple has to be big. And the reason for that, by the way, is not just greed. Greed is certainly one part of that, but it's actually because of the nature of portfolio mathematics. When you're an investor, and I'm thinking that many of you are going to join my side of the table after you have your success with your own respective companies. And when you join this side of the table, I believe you're going to just realize that, okay, early on, when you're constructing a portfolio of a bunch of companies, we have to just assume that many of them are not going to work out or return any meaningful capital. So that means you're really hunting for the 1, 2, 3 companies in your given portfolio of like 30 or 50 companies that are actually going to bring up the entire value of everything, right? So if you're a crappy investor, but like you invested at seed in Uber, it doesn't matter because like you just like 10,000x like that investment, and like that's like a 100x fund or something right there. I'm not sure if that mathematics actually works. So VCs in particular, and this is a little bit different from angels, but venture capital specifically, you are trying to hit home runs as hard as you can in order to make the portfolio mathematics work. If I'm an angel, by the way, it's a little bit different. It's my own money. I'm not stewarding anyone else's capital. So if you like 2x or 3x my money, it's fine. Like that's actually like a pretty decent win for me. So consider that when you're thinking about the profile of investor that you want to bring on. Okay. So anyway, it has to be big. And here's an example of maybe like a bad market, which is like, let's say that you and I have created this amazing trombone oil, right? This is one of my favorite examples. So like, I'm talking about the instrument trombone, right? I don't know how many trombonists there are in the world. I should probably look this up next time, but I'm going to assume that there aren't that many. But like, this is the world's best lubricant for trombone. So in terms of product market fit, let's say you have near 100% penetration and it's like generating like $5 million or even $10 million a year, right? It's not a venture backable business, I'm going to argue, because like that's not going to be able to return like 100x outcome, because even though there's great product market fit, it's just going to feel too niche, right? So it could be still an excellent business, but not a venture backable business. Now, let's say that you decide before I'm like, shutting the door on you, you're like, hold on, Eric, we also discovered that this trombone oil is a great industrial lubricant that can lube up all the machinery around the world for manufacturing. Okay, at that point, I'm just basically like gonna say like, here's all my money, just take it. Because like, now you've turned like a small market that might be measured in like tens of millions of dollars market cap or total addressable market, I should say, to something that's like in the billions or possibly even trillions of dollars. Okay, so if you go after VC, understand that this market slide is going to have to demonstrate something in the billions of dollars to implicitly make the case that if you give me money, I'm going to make a lot more money for you and me. Right? Me being the founder. Okay. Team, problem, solution, market, traction. So traction is something that I find at the early stages for VCs like myself that is sort of forgiving as well. I like to see things like, is there any early pilots? Are there like any kind of early users? The thing that we're trying to test for, at least at Hustle Fund, is your go-to-market. So about 6 years ago, there's this guy named Justin Kan. He's one of the co-founders of Twitch. He sold his company for like 900 million to Amazon. But he put out this tweet or post, X-post, whatever it's called now, that I thought was brilliant. He said that first time founders focus on product, second time founders focus on distribution. And I think that's such an accurate distillation of the founder journey. I was actually one of those founders too. When I had my first company, which I ran for 9 years, I was so obsessed with like this notion of the purple cow. There's this guy named Seth Godin. He's kind of like a pretty famous marketing writer. And he produced this book called The Purple Cow back in the early 2000s that I read. And I was like, oh my gosh, this is ingenious. He basically said like, make your product so good that it just naturally goes viral. I've now like have taken the perspective of like, this is terrible advice, because like, yes, some products like TikTok or Facebook or whatever can go viral, but those are almost impossible to replicate in like most practical settings, right? The best companies I find today are those where the founder is, yes, as obsessed with the product as they are with trying to sell, get distribution, build out go-to-market strategies, B2B to C channels, whatever it's going to be. So if you can make the case, and maybe you don't have the traction yet, but if you can make the case of a clear thesis for how you can acquire users and retain them at scale, that makes you an enormously powerful founder. Because I would say that way too many early stage founders are indexing too much on product vision, and not enough thought is given in terms of how they're going to attack the market and why they're going to win. Okay. And any early traction to show that you have like some pilots, it's nice to have, right? If you talk to Elizabeth, she doesn't care about traction. If you talk to me, Elizabeth, my co-founder, if you talk to me, then I'm going to care a little bit more about traction. So keep that in mind too if you pitch Hustle Fund, which you should at hustlefund.vc. Click on the "What are you hustling" button. Okay, so that's team, that's problem, that's solution, that's market, that's traction. And I know I went through that quickly. We will have some time for Q&A, but I want to sort of talk a little bit also about how do you distill this in practice into actual slides, right? So you get like the concepts right now, but I want you to also understand like, what does this actually look like? So if you have a chance, go to YouTube, search for Hustle Fund slide headlines. And then we put together an 8-minute video that talks about why your pitch deck headline slide titles are terrible, something along those lines. I highly recommend you watch this on like 2x speed at least, like while you're eating your breakfast or something, because it's going to distill, I think a really important lesson. And I'm going to try to summarize, I think, the key thing, which is when you're putting your pitch deck together, do not have slides that just say team, problem, solution, market, traction. Those are terrible headline slides or slide titles to have, right? Instead, what you want to do is actually have each one of your slides read as a full sentence as the title, so that if you just skim the slide headlines or titles alone, just read that alone, it creates a cohesive paragraph where 70% of what you're trying to communicate to the investor can be understood. Okay, this is a really important tactical tip, and I'll tell you why. Let's actually like play out maybe like a fake scenario here. Let's pretend that I am wearing a Patagonia vest and then I have an actual office, and I'm sitting in Sand Hill Road, which is like the legendary street of all the venture capitalists here in San Francisco Bay Area. It's 4:30 on a Thursday night. Okay. Down the road is like this bar called Madeira. Okay. And all the VCs like to go there because like it gets kind of rowdy on a Thursday night, and some of you might understand what I'm saying. But I'm not gonna actually explicitly say what happens on a Thursday night at Madeira Bar in the Rosewood Hotel. So it's 4:30, okay, and then Madeira is happening in 30 minutes. All right, and I have like 50 pitch decks in my inbox that I just need to clear out. Okay, by the way, this is not me. I'm just playing out like a horrible stereotype right now. So if you can think about like how much time each VC is going to spend in reviewing the pitch decks, it's not going to be like an hour. It's not even going to be 5 minutes. I'm going to say you have 30 seconds. You have 30 seconds to make the case to that venture capitalist that they should say, yes, I would like to meet. It's not, I would like to invest. It is specifically, I would like to meet you. So they're not going to exhaustively look at your deck in most cases. They're going to probably scan the headlines and then go back to try to look at certain details. So if you can construct the side headlines so that they read as sentences, then it just makes it easier for them to understand. The other reason why I like this method is, fun fact for you, here's another fun fact besides the midlife crisis and all that stuff, is I spent 3 months at the Boston Consulting Group as an analyst out of college. And then I was promptly fired because I could not stand working in a large company like that. But it did teach me a very important lesson, which is that during the boot camp where they train you on how to make these slide decks, and as an analyst, you're just making decks for like Fortune 500 people or something. There's a very specific method for how you do this. It's the slide headlines, just as I mentioned, those sentences, and let's just focus on that. And what I've discovered was like, wow, it's really consistent how all of these top consulting shops, like the Bains, McKinsey of the world, train their analysts on how to make these slide decks. So there's a little bit of like implicit psychology behind this too. If you can create a deck structure that kind of mimics where these super privileged consultants and bankers or how they were trained, at least in constructing slide headlines themselves, that almost creates a connection of just like, I'm just like you, right? And I think humans are very attracted to people who are just like themselves too, right? And that can be communicated through the slide deck. So I think what could be helpful here is for me to actually show you just a really quick example of how I did it with my own pitch deck for Hustle Fund 3, which is our $46 million fund that we raised in 2022. I'm not going to go through all the slides, but I'm just going to at least give you a taste of what this looks like. So let me go ahead and share my screen. Okay, let's try to do this. So again, I'm not going to go through this entire pitch deck here, but this is my team slide. Okay, it doesn't say team. It says, we are founders and builders with awesome exits and VC experience. The GPs have been friends for 22 years. Okay, you can see our pretty faces. You can see some of the fancy logos. And I think that this is a classic team deck structure, right? So you have a title that's trying to communicate that, like, you know, we're not like traditional VCs. We're actually like founders. We actually have made money, and there's longevity in the relationship, right? These are the things I'm trying to communicate here. And I'm not one to actually just like brag about pedigrees, but like this market is really implicitly biased towards people that do have pedigrees. So if you do have it, great. Try to find a way to shine light on it. The Stanford and Harvards and all that crap, right? Okay, so that's a sentence. Next slide here. I'm trying to create a little bit of social validation. So I mentioned like we've been very heavily featured in the press and all this stuff, and you know, that's what the sentence is saying. This is where we start to get into our thesis, is like, you know, we're trying to invest in companies that demonstrate hustle and market. You know, what does that actually mean? Okay, I'm just going to stop here, but you can get the sense of this, which is like, this is a very scannable slide deck here. And if you want to go back and try to understand, some more of the nuances of what we're actually communicating, you can, scan the deck first and then come back and then read more thoroughly. All right. So think about that model. All right. I think I exhausted that enough. So we talked about team, problem, solution, market, and traction, the 5 key slides. I want to summarize that team is, again, like the most important thing. So make sure you nail that slide in particular, because that's going to be the basis of, at least in the early stages, why someone should invest in your company. Now, if you're a little bit later stage, then you're going to be there's going to be much more attention around the traction, the go-to-market strategy, the market, the solution, the stuff that kind of comes naturally with a business at scale. Talked a little bit about the slide headlines. Again, you check on YouTube for Hustle Fund and slide titles, and then you'll find that 8-minute video. And the last thing I wanted to talk about was actually the shift gears for just a couple minutes. I'm going to try to spend no more than 5-7 minutes, and then I want to get to the Q&A and then also to the networking afterwards. So in this next section, let's talk about 2024, okay? And my perspectives on what this market looks like. All right. So I'm not sure if you remember, but we had a pandemic in 2020, right? And then ever since, it sort of felt kind of shitty for a couple of years. Now we did lose our minds a little bit. So between the period between like late 2020 to 2022, we had like diamond hands, like people losing their minds and their money on crypto. We had, the zero interest rate policy that was making all this free cash everywhere. I actually don't think that was terribly healthy either for anyone, but like now the conditions have changed, and you can sort of see that things really shifted towards the end of 2022. 2023 was a tougher year. We had the inflation problems, we had geopolitical wars, and now sprouting in multiple places. It was a tough year. And so what does 2024 look like? Is it going to be better or worse, the same? The quick answer, if you're just lazy, is just I don't freaking know. But I'm generally a bit optimistic. So what it feels like right now is, at least from my purview in Silicon Valley, a little context. I moved to Silicon Valley in 2000. All right. So I was able to catch the very end of the .com 1.0 era. I saw the Great Recession, and then I saw some other kind of ups and downs in between. And now here we are, right? And arguably, like we had almost like a quasi downturn, or I hesitate to even call it recession because I think technically it wasn't in America. In other places of the world, there were recessions, and there continue to be to have some recessions as well. But this doesn't feel as existential as the previous 2 crashes that I saw. At the end of the .com 1.0 era, it was like there are people who are saying like the internet was like this fad and it's done. Like it was that extreme. They're like calling the end of the internet, right? You should go back and like see these articles and from like 2001. It was like crazy. At the end of the Great Recession, or not the end of during the Great Recession, people were saying like capitalism is done even. I remember people saying like this notion of even being an investment banker is not even a real job anymore. It was super dire, right? I remember at the time, I had just left my job at Intuit as a product manager to go full time on my first company, which I had been incubating for about 3 years on the side. And people at Intuit were willingly taking like 30% pay cuts on their salary just so they can hang on to their jobs, right? Now we're actually in 2022 to 2024 era. And if you want to call it a recession, write it with a lowercase r. This doesn't feel nearly as bad. So we will get through this period. But where we have landed today as of January 17, 2024, is a period of time that feels closer to 2016 for me. So when I compare the valuations of like where the entry points are for how much you can raise, and actually even like the speed of the fundraising, the vibes of even the VCs on this side of the table, it feels really similar to around the 2016 period before we had this massive run up on valuations, free capital, and so forth. So here's where we get into like some conditions to really be mindful of, and why I think I'm a little bit optimistic cautiously. This might age like milk. We'll find out. So we have interest rates that have been going up as a way to counter inflation, right? And inflation more or less has been starting to trend back to the normalized like 20-year average or something at this point, right? It's not perfect yet, and it's still kind of going like this, but it's generally in the United States at least trending in the right way. If you're in like a different country like Argentina or some other places in the world, like I'm sure your story is very different from what we're experiencing here in the United States. So, when I'm not a macroeconomist, but my understanding is like when you raise interest rates, you're essentially taking money out of the economy, right? So, and also like you're creating other kinds of vehicles where investors with lots of money feel safer to park their cash. Like, if you can get like a treasury bill or something for like an 8% yield or something, and I think at one point I heard almost something that high, then like that sounds pretty good, right? So a few things have kind of changed in 2024. I think the Fed in the United States has signaled that they're no longer going to be raising interest rates, and they might even be open to starting to cut rates coming in the future here, maybe even this year. So that's kind of awesome in the sense that could free up a little bit more cash in the economy. But the thing that I'm tracking a little bit more is actually the emotion. So it's a little bit different now. Like we've had a kind of a rough start to public equities in the beginning of this year. It's been sort of like going down a little bit, but at the end of last year, we actually hit all-time highs for the S&P 500 NASDAQ, I think. Right. And when you think about angel investors, they actually have such an important role within this ecosystem. All right. I'm talking, and this is a very US centric kind of view. So when you're going out for your first pre-seed raises, it's now very common to do this as a party round where you don't have like a single venture capital leading this stuff. Angels have really become the party round that people will go after. And it's not a negative signal to have like 30 investors writing small checks into your first few raises. That's totally normal now, right? And even if you totally eschew VCs in those early raises, that's fine as well. So if the stock market goes up, and if you are like a tech worker, let's say, which is a very typical angel investor profile, a lot of your wealth is actually in FANG stocks, right? These are like the RSUs that are granted to you. And if it's going up and to the right, on paper, you look richer. And I think that makes you feel richer. And when you feel rich, that's when you start to see that manifest into, well, why don't I take even more risk and place money into illiquid asset classes like angel investments, which can have like this exponential outcome, right? So I wanted to tie these things together because I'm noticing, at least in the angel community that I'm a part of. So we run an angel community called Angel Squad. It has 1,500 members. You can check it out at hustlefund.vc/squad. And the sentiment that I'm starting to notice is that deals that we're putting together for the squad, these special purpose vehicle investments into certain companies in our portfolio, are starting to fund faster, more. And I think this is a canary in the coal mine of like, if public equities continues to recover in 2024, then that's going to lift all ships. And this actually applies to VCs too. A lot of our wealth is tied to the fund, but like, we still park a ton of money into public equities too. So if I'm feeling emotionally rich because like on paper, it's looking better, then I think that allows more risk-taking and more investing as well. I don't think it's going to be nearly the 2022 or 2021 era of craziness. I think it's going to be much more muted, but it's going to be better is my take. And it just feels like across our portfolio that these fundraisers are coming together quicker and more easily than before, right? But as I sort of like leave this kind of macroeconomic talk and then open it up to open Q&A, I want to leave you with this last comment, which is a reiteration, which is it's normal now to do your raises primarily through angels, especially if you're early on at the pre-seed and seed stages. If you're going to do this, then all you need to do in the United States, at least, is find an accredited investor. And an accredited investor is not like a director of product at Google or something like that. Yes, that person probably can be an angel investor, but it can also be your neighbor. It could be your dentist. It could be a service worker, a service provider, like someone who runs like a plumbing company or whatever. Like those people who can meet the threshold of at least a minimum investable assets personally, or making at least $200,000 a year, or as a couple of $300,000 a year, is an accredited investor who can potentially be your investor, your doctor, lawyers, and things like that. So if you're in an area where you're just trying to cold start, but you find like someone that really believes in you who can meet this accredited threshold, I would offer maybe a chance for those people to also participate. And I'm going to just like leave you with one last thing too. I actually think you'll benefit by having people who don't view themselves as angels on your cap table. There's something to be said about having a little bit more diversity on your investor cap table. You know, if you just fill it up with dudes who are great engineers, all work for FANG companies as your angels, you're going to get a really myopic view of what this company should become from your investors. But when you bring in people who are a little bit outside of the bubble, those that don't like necessarily live and breathe within tech, they may be able to help you with a differentiated network that you don't have access to, or even like a perspective that can bring you back to reality of what you're trying to do to grow this company at scale. Because at some point, every great company stops just being about serving the San Francisco Bay Area, like Uber for cats or whatever, and then starts becoming about like serving the entire population of like a larger market, right? And we can always use more good people on the side of the table too. Okay, I'm going to pause there. I hope that our discussion around the slides, the headlines, and a little bit about the macros were helpful. And if there are any good questions out there, I'm happy to stick around. I got 22 minutes personally to answer any questions that you might have.
Perfect. Thanks so much, Eric. I think your content was so on point. It's exactly what we were looking for at F5 to start off 2024. Just for context, because I don't think you had about 500 people live listening to you, and like a lot of great comments, a lot of great stuff that's happening in the chats. All right, I don't want to waste any time. Let's kind of jump into as many of these questions. Folks, go into the Q&A button, Q&A section, because there's a bunch of upvotes you can do so we can prioritize the questions. And let's just kind of go. I'm going to be picking from the top. All right, so the first question, you should be able to see it. So the first question is from Sean from Miami. He's like, are VCs the correct path for pre-product, pre-revenue startup? Is it better to secure initial funding through angel investors? You've talked a lot about this, but maybe just highlight some of the top things.
Yeah, and before we get started, I just want to reiterate, like, thank you so much to the Founder Institute team and also to this community for giving me a chance to have some of your time today to have this discussion. It's a real honor. So, Sean, thank you for this question. Go with angels. That's it. I mean, yeah, sure. As a VC, I would love to participate early as possible in your company. And we try to position ourselves to be as founder friendly as angels. But when you think about like the seed phase, I actually view seed as almost like an artist phase, right, of any company. And the goal for a seed company, I think, is to turn entropy into structure. So if you remember like your high school chemistry class, entropy is like complete randomness, right? Structure is structure, right? So you have all these like carbon molecules like all over the place, and then somehow like some sort of event, like a lot of pressure happens, and then at the very end of it, you structure it into a diamond, right? And that's what we're all trying to go after. And what I really love about the seed phase is that it almost gives, there's almost an understanding and a social contract with your investor that you should have permission to dream and experiment. So like I might start by saying like, I want to create Uber for pets or something like that. And then, but then I realized like, as I study the market, that I need to evolve, do pivots along the way, big and small, and then figure out like what the actual like problem I want to actually solve within this market is going to be. That's going to serve like a huge outcome for everyone. And the problem with taking VC money is that there's an implicit pressure for you to grow really fast, raise really fast, so that the VC themselves can see markups on the paper value of your business with subsequent raises. Okay. And why is that important? Well, if I can report that like my investment 6 months ago just 10x'd on paper, I can use that as a case study to go to my own investors and say like, hey, we're raising our next fund. Look how smart I am. Like this company like 10x within like 6 months. So give me more money and more management fees, right? It's sort of like you stack these funds on top of each other. Angels don't have that kind of implicit pressure, right? It's their own money. So if you don't have a markup or whatever, then it's okay. They're going after like cash on cash gains at some point in the future. Right, VCs are going after that too, but I wanted to highlight this bias because there's a time to take the VC money. That's when you realize like I figured out like I'm really close to product market fit, or I found it, and now I need to scale fast. Where the incentives sort of naturally align with each other the best. But if you're really really early, I think you go after angels or angel-like VC funds. Again, I'm talking my own book a little bit here, but if it's just even angels alone, that's probably what I would do. Or even better. The best, Sean, take no outside capital. If there's any way for you to finance this thing through other kinds of means to get to product market fit, and you have 100% ownership of your cap table, 100% ownership of your own time, that's awesome. So try to do that first.
We should just end it right here. Just everyone just go out there, Go generate revenue and then
Yeah,
don't
make
touch.
that money.
Yeah, awesome. Let's keep it going. But appreciate the depth. Rob from New York is asking. He's noticing that a lot of people are sending out these investor memos. So as a VC sitting on the other side, are you for these investor memos, these summary type of memos, or do you prefer the traditional deck?
I'm not as strongly. I don't have a terribly strong opinion about this. The memos are okay for me. So I think that can work, but I actually do like the slide decks more. And the reason why is investor memos. This makes sound. I'm gonna sound a little bit bad here. They feel a little bit lazy at times. What I really like about testing people on their slide decks is that it kind of forces you to distill communication down to it's like most like basic core. And I like to understand, how founders communicate on a variety of different kinds of channels here. And also the reality here is too that like even if you don't have to create a slide deck just for your investor, you may still need to create like a slide deck for when you're trying to do sales with like a big corporate partner or something like that. It's just like a very normalized asset. So I prefer decks personally. I think that just like seeing how people summarize and visualize their vision is really important. Notion decks or Notion memos are acceptable, I suppose. And there are actually some VCs that prefer that. So I guess my answer for you would be, why not both? Right. I know it's a little bit more work, but I actually do think that it's worthwhile.
Awesome. Thanks. I really like this question from Yeji from Boston. I'll just read it out. It's regarding traction. You said you're the one who really likes traction. So can you elaborate on how the unit economics play a role with your GTM strategy, and how do you actually assess the path to profitability of founders' ability to provide clear unit economics in their thesis into your equation as a VC? I guess to summarize this, like, how are you actually looking at traction and evaluating it as a VC? As sitting as Eric, what's your
Yeah.
and how you?
I'm going to tell you guys a little bit of secret that sort of answers this question. I'm going to really directly answer this question. So I have a ritual. I've got a little boy and a little daughter. And then for my little boy, we usually take a shower at the very end of the day, right? Together. And it's a really nice ritual because like we have great discussions and things like that. Every night I actually pitch him on a new company that's pitched me to see whether he understands it. Okay. It turns out, by the way, he really hates Web3. So like when I try to like get into like token economics and things like that, he's like, this makes no sense. What he loves is B2B SaaS. So and the reason why is like he's like, oh, so you're saying that like more money comes in than leaves, and then these people are committed to paying for like a year at a time. Like this makes like a lot of sense, right? So it's like a fun litmus test for me actually to test like some of our company investments as well. But what I said last is actually kind of the thing that I think about a lot as a grounding principle of what makes a good business. When I took high school economics, I remember that there's this concept called a going concern. And the way that I understand it is more money comes in than leaves. That's it, right? At the end of the day, like I need to be able to answer the question of like, is there a path, or is there already currently a path where more money is going to come in than leaves? And if that's like clearly the case, then this is actually a real business here, right? So I really think that this is actually even like one of the most basic principles of like what you need to argue in your pitch deck or when you're talking to a VC that's often missed, right? Like so much is discussed around like, this is why a product is better, like 10 times better than someone else's, or why this market's amazing. Yes, all that stuff is really important, but usually the mechanics for making the more money come in than leave part is just go to market strategy. You may not have the evidence yet of like, oh, if we invest in Facebook ads, like we can get like a 5x return on spend or something like that. Maybe that doesn't exist yet, but if you at least have some sort of strong thesis for why you believe that you can achieve that, or even evidence from like a previous startup you did or like another role where you were able to achieve that kind of stuff, then I think that makes a really strong case that this is not a science project that we're funding here. This is actually a real business. And what I really worry about is that too many, this is going to sound like such an asshole comment, but I'm going to say it, which is like that too many founders think that they're starting a business when they're actually starting a science project, right? So like stress test that on yourself. And the way that you can really answer that question of like, no, this is a business, usually comes down to go to market, right? So again, earlier on is kind of a little bit more thesis driven, and then or just like sort of speculative, but you should have like a strong thesis. Later on, though, you need to have real evidence. Like you gotta have like LTV to CAC ratios across all of your channels. Like maybe even like signed documents to show that, oh, Google is going to resell this stuff like all over its like enterprise partners, all that kind of stuff.
Awesome. Thank you so much. So we have a couple questions here. I was just going through them as you were talking. So I'll pull this one up from Maxime from Germany. How much percentage should you be giving away at the pre-seed, seed, post-seed level? And then there was like 3-4 questions that are similar. It's like, well, how much should I be giving up if I go the venture capital route? I know there is no hard or fast rule, but what's some guidelines that you can share to some of the founders that are joining us today?
Yeah. I'll just answer one dimension of this because I think the majority of you are probably
Pre-seed.
in the seed phase. So don't sell more than 35% of your cap table before the Series A if it's possible. You know, less is better. More than that is starting to get a little bit dangerous. So why, right? Why does this matter? What if you sell like 60% or 70% of your cap table before the Series A? Well, in that kind of scenario, there's actually a big problem, which is there's not enough cap table left for you or future investors or even future employees. Like if you give away too much at the cap table early, then like you're a Series A, Series B, Series C investor might say this is a dirty cap table, right? Like it's just way too oversold. You're not going to be able to attract the best talent or even the best VCs because there's just not enough ownership left. So less is better, but there's a really important principle that you need to understand, which is let's say that you're insanely good at negotiating. Okay, let's say I raise $1 million at a $100 million valuation before the Series A. Okay, so I've effectively given up 1% ownership, basically no dilution. Like that's almost like free money, right? The problem is that there's a general rule of thumb in venture capital of what a great venture backed business looks like, which is effectively you should be trying to double the valuation of the previous raise. Okay, so the problem with raising money at a $100 million valuation before your Series A, is that you're basically saying like, I think I can raise my Series A at a $200 million valuation or more. That's not going to happen. All right, like you need to have like unbelievable, like skyrocketing, results right now in your business in order to make that happen. So you actually might be ingesting a poison pill by with a delayed trigger, right? By taking this money on unbelievable terms, right? From possibly an unsophisticated investor. A good investor should tell you like, there's no fucking way I'm going to give you $100 million valuation because it's bad for me and it's bad for you actually, right? Like someone's got to be shaking you in the shoulder. Sorry for the bad language. So think about it like this, which is like, just because you can, you shouldn't necessarily, right? Like if you're trying to raise like $1 million, I would say that the healthy range is like give up between 15% and 35% before your Series A, and you should be okay. And if you find someone that you really, really like, who's willing to give you like a really high valuation, maybe you negotiate yourself down and say like, that's actually unnecessary. We want to give ourselves options. So even though you're offering the seed at like a $30 million post-money valuation right now, that's awesome. Maybe it'd be healthier to pare back to like 20 million or 25 million maybe, because then that basically means you're looking for like a 40 or $45 million post-money valuation at the Series A. And that can put you on a healthier path. And in this market, Series A valuations are dropping pretty fast. In fact, I've even seen them as low as $20 million now in some cases, right? It's getting a little bit better, but it's not great. So don't ingest that accidental time-delayed poison pill, because I've seen it kick a lot of people in the butt right now. And you can actually see it manifest now, because you're seeing like these layoffs, right? You're seeing like these companies shutting down that raise all this money. They ingested the poison pill by raising too much during the ZERP era and are now paying the consequences for it. So I don't want that to be you, because there are cases where you have an insanely good business, but you just run out of money because you just screwed yourself on the cap table.
Awesome. Very, very sound advice. I want to pull up this question by Ray from Aachen, Germany. You said this was your first slide, the team slide, and I think like it'd be great for you to double click on that a little bit more. Do you need to have a team to raise? Like he didn't specify whether it's angel or VC, but maybe if you can touch upon both. I think it's an important concept that we're emphasizing a lot more at FI, that a lot more founders need to come to terms with. Like, hey, I need to go find that co-founder because my likelihood of investment will increase, right? So would love to
Yeah.
get your thoughts on this dynamic.
Yeah. By the way, I love seeing so many people in Germany listening in. My son's a big Bayern Munich football fan, so I'll tell him that later in the shower. So okay, so can I raise without team? The answer is of course you can. There's many examples of great solo founders who've been able to do this. Now, I will say that there is sort of a bias. I actually do know that there's a fair number of funds who prefer to see a co-founder. And I actually was a solo founder for 9 years in my first company, and after that experience, the business worked out fine. We had a good outcome, but I swore I would never do that again. And the reason why is because it's so emotionally lonely. Just talking about this for a second here. Like, the great thing about having co-founders is, especially if you find the right co-founders, they really are like siblings to you, and the right co-founders are people that absolutely have your back, right? It's for me, Elizabeth and Sheehan, my two other co-founders, these women, I would trust them. Like, if I were like in God forbid, like some sort of like catastrophic accident, and like they needed to make a decision to pull the plug without my wife, I would trust them to actually make the right choice, which is to pull the plug. So like, it's that level of trust. And for the vast majority of founders out there, even when you do have co-founders, how lonely this feels, right? Like, it's not like you can talk to your mom and dad or even some of your closest friends who are not founders and having them truly understand how difficult and depressing this can be. But when you have co-founders, you lean into each other, at least the right ones, right? So I understand the bias towards having co-founders. Now, that being said, as long as you can answer the question of like, why am I like the right person with the right kind of relevant background and skill set to solve the given problem in the market, then it is what it is. And if you maybe want to try to hedge a little bit to make it feel like you have a co-founder, like if you have some early team members who are like really senior, like founding team members, you can also highlight them. They're not going to be co-founders, but they could be people who are really invested into the business, and showing that on a team slide might be enough to sort of mitigate any possible bias against solo founders. All a long way to say, like, if you're a solo founder, lean into it. It is what it is, and it's not necessarily any indication that it's going to be a predictor of failure in this business. But that said, outside of what this question is, you got to find some fellowship with other founders that you can lean into as well. If there's like taking like a weekly walk or something with founder friends who are also in this journey as well. I just think from a mental health perspective, that kind of fellowship is really critical.
Awesome. Thanks. We have 5 minutes, so let's try to do one last question.
Certainly.
Let's bring up this question from Will from Chicago is asking, and I think this is a good one to end with. It's like, start fundraising is tough in 2024. What are some effective strategies or approaches that you think the entrepreneurship and founders on this call today should be doing? Should they be doing cold outreach? Should they be finding more hustle funds? Should they be doing like more research? Like, what is your last piece of advice for the folks here?
I want to respond to this in two ways. One is kind of more philosophical, and the second is tactical. So here's the philosophical. I've noticed we've invested in 500 companies, more than 500 companies now at this point at Hustle Fund across 3 funds in the last 6 years. And what I've noticed is that the very best performing companies, I'm telling you, like the ones that are like true breakouts that are going to be single like fund returners for us, more than 100x. The pattern I'm noticing is that their early fundraisers were horrifically hard. And this actually reminds me of like a principle that either Warren Buffett or the former and like legendary Charlie Munger once said. One of those two said, like, if you're going to make a lot of money in business, you have to be both contrarian and right. So for those of you who may be struggling with your fundraisers right now, or getting these kinds of no's that you're not anticipating, or you're just feeling frustrated, this actually might be a signal that you're working on something that's both contrarian and right, that can have incredibly outsized outcomes. And VC is generally a lagging indicator. We're not like that smart. All we're doing is just following founders' visions, right? Very few of us actually have forward-looking visions. So like philosophically, just understand that like sometimes the very best businesses are just going to look like really terrible businesses in the beginning until they're unbelievably good businesses. And I see this play out over and over and over again in my career as an angel and then as a VC. So little bit of pep talk there. Now, tactically, how do I like tackle the fundraising problem, getting more leads and so forth, which is I think the heart of this question. So if you have any early investors already on your cap table, or maybe founder friends who are willing to raise their hand and try to help you, there's a common mistake that many founders make in trying to leverage these people for more leads, which is they'll say like, hey, here's my pitch deck, my blurb, whatever it is. Can you send this to anyone who might be a good fit for investing in my company? The problem is that you're never going to get a response. It's too much analysis paralysis, paradox of choice, right? Like, you're making me think too much. The better question to answer or to ask, which is what we do when we started Hustle Fund to raise all this money, was, hey, here's my pitch deck, my blurb. Can you send this to one person, just one, who you think will be a perfect fit for investing in my company? And then suddenly the response rate went to near 100%. And then usually it was the richest person that person knew. So like, for us, like that really cascaded into like, wow, now we're breaking into like this whole like family office world, like this like kind of shadowy rich area that like of all these people are funding us. But this is the thing that I really challenge you, which is like, don't ask for many, just ask for one. Because it's going to make it much easier for someone to make a decision to just like pass along your blurb and your deck to just that one person. B, they're going to be much more filtered down to someone that has right fit. And C, like, even though this isn't like a viral K factor number, like I'm telling you that this naturally does cascade somehow into more virality, or let's say a much more like fresh leads, more than just like that one person over time. And you just keep going and going and going. And sometimes the only way that you can raise is through brute force. Like, for me, for our first fund, which is $11.5 million, we pitched 700 people in 9 months to get to $11.5 million, right? So, be prepared to talk to hundreds of people, at least to get going. And, if you stick with your vision and really believe in it, it'll be worthwhile. Get through this phase and then just show people how great your business is over time.
Okay, awesome. I think we're right on time, right on the hour. Eric, thank you so much for taking the time. I'm sure a lot of people enjoyed today's content. Folks, you're going to get the recording after, and be sure to check it out. There's a lot of nuggets. Like Eric, thanks so much. I know if you have to hop off, that's fine. We can touch base right after. But yeah, folks, please use the emojis to show Eric some love. And Eric, where do you want people to find you? Is it?
Yeah. Well, I guess the best ways if you have a company that you'd like to engage with us to see whether this fit for Hustle Fund, check us out at hustlefund.vc.Victor Charlie, and click on the "What Are You Hustling" button. We'd be so honored to get a chance to engage with you. Our investment team monitors every single company that goes through that pipeline. I personally monitor it myself, so we are engaging with everyone there. That's the easiest. Follow me on Twitter at Eric Bahn or on LinkedIn. And just a final shout to the entire Founder Institute team for putting this together and this community. I know how busy y'all are, and this is a special community. I've been a part of it before. I know that they have access to way more impressive people than myself. So I'm deeply honored that you gave me this chance. And it's a special global community to be part of. So already you're ahead of the curve in finding a wonderful fellowship as you build your businesses together.
Perfect. Yeah, thanks so much for the kind words, but yeah, this has been awesome. I know we're going to dive deeper into all of this content right after this call. Folks, we're going to wrap things up in a minute. Once I end this session, feel free to go network with each other and talk more about what you've learned. Check out fi.co to learn more about Founder Institute. I'm also throwing in a link to everyone, so just click that and then we can go forward from there. All right. Thanks, everyone. Enjoy the rest of your day. Eric, thank you so much. And hopefully everyone got value out of this. All right.
Thanks a lot, everyone. All the best.